The path to home ownership is not a one-size-fits-all, and for many buyers, PMI becomes an important part of the process. Let's welcome Elizabeth.curry, Vice President of Mortgage Lending for Guaranteed Rate Affinity. Elizabeth, thank you for being here with us today.
Thanks, Taylor.
Before we dive into it, what is PMI? What does it stand for?
So PMI stands for Private Mortgage Insurance. It is required for anyone who doesn't have at least 20% down on a conventional loan.
Okay, and this has been around for a while.
Yeah, so PMI started in 1958 by a guy who was irritated in saving up that 20% in order to buy a home. And so he created PMI as a way for people to buy a home that don't have 20% down.
Yeah, and it's evolved over the years, but I mean, what an advantage, right? Because it's not as easy, you know, to save 20% down on a down payment. So what are some of the disadvantages of PMI?
So disadvantages really of PMI is it protects the lender. It doesn't protect the consumer at all. It protects the lender against default.
Okay, so as far as advantages go, it's really just so the buyer doesn't have to save up that large amount of money.
Right, first-time home buyers can buy a home with as little as 3% down with a lot of lenders.
Yeah, so how is PMI calculated? Are there does credit score come into play?
So PMI is calculated depending on your loan amount, your down payment amount, your credit score, your DTI, what type of home you're buying, if you're buying a condo or a single family home, and if you're using it as a primary home, a secondary home, or an investment.
Okay, and so it attaches itself to the monthly mortgage payment, right?
Right.
So on average, I mean, could you give us an example of what that would look like on a payment?
Right, so let's just say you're gonna put 15% down instead of the full 20% down. It's only $58 on a $500,000 loan amount.
Okay, that's good to know. And
with a good credit score and a
yes.
single family residence and all that other kind of good stuff.
Yeah, how common is it today for people to have to use PMI?
Really common. Especially in the first-time home buyer market. The people that don't have a home to sell that has got, you know, that nest egg of equity in their home to put into their next home.
So PMI is required for people that don't want to put 20% down. So are there any other options?
So you can do lender paid PMI, which means you increase the interest rate a little bit, and then you don't have that monthly payment.
Okay.
You can do seller paid PMI, to where they pay the lump sum for you at closing. And then you can do a combo of a little bit of borrower paid in the monthly payment, which is pretty traditional, and a little bit of the seller paid.
Can you remove it at any point?
Yes, so in, I think it was 1989, they came out with, as soon as you hit 78% of the original equity of your home, it automatically goes away. Now, most mortgage insurance carriers will allow you to remove it after 2 years of good payment history, as long as you have reached that 80% equity, or 20% equity in your home.
And as someone that, you know, works with this every day, do you have any advice for someone or one thing that you wish buyers knew about PMI before even starting the home buying process?
Sure, so PMI really is lender based, so you've got to meet with someone who really understands your short-term goals and your long-term goals, that presents those different options of mortgage paid, borrower paid, lender paid, those split premiums, and someone who's backed by Fannie and Freddie that offer a really good premium amount. Not every single lender offers the same premium amount.
Yeah, that's great to know. We're going to put your website up so everyone, if they want to learn more or reach out to someone who does know, you'll be able to do so. Elizabeth, thank you for being here with us and sharing those insights.
Appreciate it.
We're back in 2 minutes.